Imagine this. You open your investment app like you do every morning. You scroll to check your favorite stock. But today, something feels different. The number is still there, but it isn't moving. No green. No red. Just zero. Not down a little. Not recovering later. Zero. The money you worked months to earn. The money you trusted a company, a project, or an idea with. Gone. And suddenly a million questions flood your mind. Do you still owe money? Can you ever get it back? Is this the end of your financial journey? Today, we're going to answer those questions calmly and clearly. Because understanding what happens when an investment goes to zero can save you from some of the most expensive mistakes an investor can make. Let's start with what going to zero actually means. When people hear this phrase, they usually imagine the absolute worst-case scenario. And emotionally, it's terrifying. But financially, zero has a very specific meaning. It means the market believes the asset no longer has any value. That can happen for several reasons. A company goes bankrupt. A project fails. A product becomes obsolete. The market loses confidence. Or the structure of the investment collapses entirely. Here's the first key rule. If an investment goes to zero, you lose only what you invested. You do not owe the market more money. You are not in debt because of the investment itself. If you invested $1,000 in a stock and it goes to zero, your loss is $1,000. Period. Zero is painful, but it is contained. Now, let's talk about stocks, because they are the most common type of investment. When a stock goes to zero, it usually means the company behind it has failed. How does that happen? Through bankruptcy, delisting, or liquidation. When a company files for bankruptcy, it enters a legal process to settle its debts. Employees, secured creditors, unsecured creditors, and bondholders are all paid first. Shareholders are last. That's why in most bankruptcies, shareholders receive nothing. Your shares may still technically exist, but economically they are worthless. Can a zero stock ever come back? Technically, yes, if the company... But here's the reality. When a company restructures, old shareholders are almost always wiped out. The company survives, but ownership is transferred to creditors. Your old shares don't recover. They are cancelled, replaced, or diluted. This is why experienced investors have a strict rule. Never rely on hope after fundamentals are broken. Hope is not a strategy. It's an emotional attachment. What about ETFs and mutual funds? Can they go to zero? Almost never. A fund going to zero is rare because funds hold multiple assets. But they can be shut down if the underlying investments fail. When a fund is closed, the assets are sold and investors receive whatever remains. If the underlying assets lost value, your return could be very small. The key difference is this. Funds don't die suddenly. They fade slowly, giving warning signs. Shrinking assets, low trading volume, or tracking errors. Diversification across multiple funds is the reason many investors survive financial storms. Now, let's talk about crypto. In crypto, zero is not rare. Coins and tokens can collapse completely because the project fails. The team disappears. Liquidity dries up, or trust evaporates. Unlike stocks, crypto has no bankruptcy protection. If a token goes to zero, there is no legal process to recover anything. It simply stops. That's why experienced investors treat crypto differently. Crypto is not ownership. It is belief. And belief can disappear overnight. Next, we need to discuss options and leveraged products. Options that expire worthless go to zero. That is not a failure. That is the design. But leverage can be dangerous. If you buy on margin or use borrowed funds, the losses can exceed your initial investment. This is the crucial distinction. Zero is survivable. Debt is not. The financial loss is only half the story. The real danger is psychological. People who lose money experience shame, loss of confidence, fear, and sometimes paralysis. They stop investing for years and miss the biggest compounding periods of their lives. Often, the people most affected aren't reckless. They are overconfident in one idea, emotionally attached, or under-diversified. The market didn't punish them for investing. It punished them for concentration without risk control. So how do professionals deal with the possibility of an investment going to zero? They expect Italiano. They plan for it. Some ideas will be wrong. Some companies will fail. Some bets will go to zero. But they survive because no single investment can destroy them. Losses are sized intentionally. Risk is kept upfront. The rule is simple. Never let one position decide your future. What should you do if an investment you hold goes to zero? Step 1. Accept it. Emotionally. Don't deny it or pretend it didn't happen. Step 2. Document the lesson. Write down what went wrong and why. Treat it as a learning experience, not a regret. Step 3. Rebuild slowly. Avoid aggressive attempts to recover. Stick to your plan and rebuild your portfolio carefully. Step 4. Diversify deeply, not superficially. Spread your investments so no single zero can ruin you again. 1 zero does not define your intelligence. It defines one decision in one moment. And markets give infinite second chances if you are still in the game. Here's the bigger picture. Every successful investor has a graveyard of failed investments. Stocks that died, projects that failed, capital that vanished. The difference is that they survive long enough to learn. Because in investing, the goal isn't perfection. It is Zero is only fatal if you bet everything borrowed to invest or quit afterward. So, if an investment goes to zero, remember this. You do not lose your future. You lose a chapter. What matters is whether you keep reading or close the book forever. Wealth is not built by avoiding losses. It is built by outlasting them. And outlasting them is exactly what separates people who fail from people who succeed.